On March 6, 2026, China's premier announced simultaneous rate cuts, reserve requirement reductions, and structural monetary tools. On the exact same day, Hong Kong Customs seized the largest precious metals smuggling operation in the territory's recorded history. Gold and silver plates hidden inside cheap electronics, same day, same market. And almost every Western precious metals channel missed the connection entirely. I'm Marcus Caldwell, independent market analyst. I've been tracking the structural silver thesis for 3 years. What landed this week is not just another stimulus headline. It is the simultaneous convergence of every variable that serious silver analysts identified as the trigger for a historic move. Supply restriction, demand acceleration, physical desperation at the street level, all three activated in a single 72-hour window. Here's what I'm going to walk you through today. Why China's monetary levers matter more for silver than for any other asset. Why the Hong Kong seizure is a desperation signal, not a crime story. Why the structural setup in 2026 is more severe than the 2005 copper precedent that tripled prices within 12 months. And what the smart money is actually doing right now. Before I reveal the next critical data point, if this intelligence is valuable to you, hit that subscribe button and turn on notifications. The equity edge exists to give you the market intelligence that institutional desks track, but retail investors rarely see. Independent analysis, no products, no signals, just the data. Now let's get into what the smart money is actually doing. Section 1. Why China's rate cuts are a direct silver catalyst. China consumes between 60 and 70% of the world's refined silver supply through its industrial base. That number is not a projection. It is the documented annual consumption figure. When China's premier pulls three monetary levers simultaneously, rate cuts, reserve requirement reductions, and structural tools, the transmission into physical silver demand is not measured in weeks. It is measured in days. Here is the mechanism. Cheaper credit reaches the procurement desks of tens of thousands of factory managers who have been deferring silver inventory purchases because financing was expensive. When credit loosens overnight, deferred inventory becomes immediate orders. TD Securities' head of commodity strategy, Bart Mellick, documented exactly this dynamic during a prior China stimulus cycle. His analysis confirmed that silver broke through major resistance levels on the announcement day itself, not after consolidation, not after weeks of price discovery. On the day. Because the signal from Beijing to the factory floor in China moves at the speed of a policy announcement, not the speed of a quarterly earnings cycle. Now layer this against what China did to its silver supply simultaneously. China's 2026 export controls restrict silver exports to 44 licensed entities. That single policy change cut off 60 to 70% of global refined silver supply from Western markets. The same country that consumes the majority of the world's silver supply just made it structurally cheaper for its own factories to buy more silver, while simultaneously making it structurally harder for anyone outside its borders to access that supply. This is not a coincidence of timing. This is a coordinated industrial strategy that mirrors China's rare earth playbook executed between 2010 and 2015. And Elon Musk, CEO of the largest electric vehicle manufacturer in the world, confirmed the stakes publicly when he responded to news of China's silver export restrictions with 3 words. This is not good. Every EV needs silver. Every solar panel needs silver. And the nation that refines the majority of global silver supply just restructured access in its own favor. Section 2, the Hong Kong seizure, is the most important data point nobody is discussing. Law enforcement at Hong Kong International Airport uncovered silver and gold plates adhesively bonded to the interior base of inexpensive consumer electronics. This was the largest precious metal seizure by value in Hong Kong's recorded history. The date was March 6, 2026, the same day as Premier Lee's announcement. I want to be precise about why this matters analytically. Criminal arbitrage only operates at scale when the premium between two markets becomes large enough that the risk of imprisonment is economically rational. The Shanghai silver premium relative to Western paper pricing has been running at 12 to 13% above spot. At that spread, the economics of physically moving silver across a border illegally begin to make financial sense to people willing to accept the legal risk. This is not a story about criminals. This is price signal data delivered through the behavior of market participants operating outside official channels. When physical demand desperation in the world's largest silver market reaches the point where people are gluing silver plates inside electronics to move it across borders, the official supply channels are not clearing the market. That gap between official supply and physical demand is the setup. China's rate cuts are the accelerant. Section 3. The 2005 copper precedent and why silver 2026 is more severe. Michael Oliver of Momentum Structure Analysis has publicly cited China's 2005 strategic copper accumulation as the closest historical precedent to the current silver setup. In 2005, China began accumulating copper as a strategic industrial material. Within approximately 12 months, copper prices had tripled. The mechanism was identical to what is now in place for silver, a single dominant consuming nation using cheap credit to accelerate procurement of a metal with constrained global supply. But here is why the 2026 silver setup is structurally more severe than 2005 copper. First, copper in 2005 had functioning global supply chains with no export restriction. Silver in 2026 has a 60 to 70% export restriction from its primary refining nation already in place. Second, copper in 2005 was a single identity industrial commodity. Silver in 2026 carries what analysts at BingX have described as a triple identity. Industrial, required by the factories that China's rate cuts will finance. Monetary, positioned as a store of value in the same de-dollarization wave that drove 16 consecutive months of PBOC gold buying. Strategic, formally designated as a critical mineral by the United States and simultaneously reclassified as a strategic material by China. Both superpowers have arrived at the same conclusion about silver's strategic importance at the same moment. Third, the COMEX registered silver inventory is being depleted at approximately 785,000 ounces per day. At that depletion rate, the physical delivery infrastructure underpinning paper silver contracts faces structural stress that has no equivalent in the 2005 copper market. CME Group data confirms that precious metals delivered 170% price returns as of January 6, 2026. That performance came before China's rate cuts, before the March 6th announcement, before the Hong Kong seizure confirmed physical demand desperation. The honest counter-argument: China's domestic consumption has been structurally depressed despite multiple prior stimulus cycles. JP Morgan's own economists flagged that China's growth projections of 4.5 to 4.9% GDP for 2026 carry execution uncertainty. U.S. secondary sanctions tied to the Iran conflict, targeting Chinese entities doing business with sanctioned Iranian counterparties, could simultaneously restrict Chinese economic activity at the exact moment Premier Lee's rate cuts are designed to expand it. The stimulus signal is real. The transmission of that stimulus into silver demand is not guaranteed. That is the honest position. What is not uncertain is the structural supply restriction. Export controls do not require domestic consumption to accelerate in order to tighten the market. They tighten the market through restriction alone. The rate cuts are the demand accelerant. The export controls are the supply constraint. Both are already in effect. Watch list: 4 indicators to track. Right now, watch COMEX registered silver inventory at cmegroup.com. Depletion below 25 million ounces triggers structural delivery stress. At the current rate of 785,000 ounces per day, that threshold arrives faster than most retail participants are modeling. Watch the CFTC commitment of traders report at cftc.gov every Friday. Specifically, track managed money net long positioning in silver futures. Institutional accumulation before a major move shows up here first. Watch the Shanghai silver premium relative to London spot. A premium sustained above 15% signals that official supply channels are failing to clear physical demand at current price levels. That is the threshold at which the arbitrage becomes irresistible at scale. Watch the Federal Reserve's next rate decision in the context of China's simultaneous easing. If the Fed pivots to cuts while China is already cutting, both the world's reserve currency issuer and the world's largest silver consumer will be expanding monetary supply simultaneously. That is the dual monetary expansion scenario that structural silver analysts have identified as the highest probability trigger for a move beyond current resistance. The physical stacker, who acquired silver at $20, at $30, at $50, holds the one position that cannot be margin called, cannot be cash settled at an exchange-determined price, and cannot be diluted by a central bank decision. The paper trader holds a contractual promise, backed by an inventory that is being depleted daily. The stacker holds the bar. China just cut rates. China already restricted exports. Hong Kong just confirmed that physical demand has reached the level where criminal arbitrage is economically rational. And silver is trading below JP Morgan's own published average price target for the full year. The data is public. The sources are verifiable. The map is in your hands. Write Converge in the comments right now if you're tracking this setup. This is market intelligence education, not financial advice. Verify every data point before you act. The Equity Edge. Independent analysis, no products, no signals, just the data.